All right, so welcome on back. Today we're going to be walking through the Exam 3 review for Accounting 2302, which of course is managerial accounting. So we're going to be looking today at those 3 chapters. This video is going to take us a while. It's going to take us a good bit to get through all of this, but I'm going to try to take it at a nice slow pace. So hopefully we can really understand each step that I'm taking. And so you can find this video extremely helpful. At the end of the day, I know the video is going to be long. That's okay with me, because what I want is for you to feel like you really get something out of watching this video and that you feel very well prepared for the test and just for going forward with this knowledge after you take the time to either watch this video or work through the review, whatever it is. So keep that in mind. If at any point you are confused about something we do, as always, don't hesitate to reach out to me. I'm always happy to meet with you during office hours or anything like that to help you get all that straightened out. So very good. So here we go. First thing I want to note about this very first problem that we're going to look at is the actual exam will likely have you do this or do a direct materials budget for 3 individual months. So I picked this one for the review video because the process is identical. Even if you do this for 3 individual months, you just do it 2 more times. And this review video is going to be fairly lengthy anyway. So I wanted to try to pick and choose the problems where I felt like we really needed to see that expansion and the ones where I felt like we could kind of get by without it. And so this problem I picked, we're going to do this all as 1 quarter instead of 3 individual months. But there is a problem on your homework assignment that has you actually do this across 3 individual months. So that's perfectly fine also. So I do strongly suggest that if you are at all worried about, well, that formatting is going to mess me up on the test, I need to see it done for 3 individual months, go back to chapter 20. We'll look over the problem in the homework that deals with this as a broken out 3 individual month problem. And then if you're still struggling, you still have questions, of course, come talk to me and I'll be happy to help you with that. So here we go. In this case, we're working on the direct materials budget. And remember, that comes in our line after the production budget, which means we know how many units we need to produce, which means that that's where we need to start. So units to be produced. In this case, we were told that's 240,000 units. And we were told that back up here in the actual text, which I think I skipped over it, but let's go ahead and look at it. Rita is a manufacturer in a seasonal industry. They're preparing the direct materials budget for the 2nd quarter. Plans production of 240,000 units in the 2nd quarter. And it plans production of 52,500 units in the 3rd quarter. Okay, all of that's very important information. Now they give us raw materials inventory, 43,200 pounds at the beginning of the 2nd quarter. And then down in that green box, we get some other information that's actually very useful also. So each unit requires, so this is what we care about, 0.6 pounds of raw materials priced at $175 per pound. Now there's one other thing we need to know, and that's their policy in regards to ending inventory. The company plans to end each quarter with an ending inventory of materials equal to 30% of next quarter's budgeted materials requirements. So we've got all the information we're going to need as we walk through this problem. So here we go. We've got our units to be produced. Of course, that's what we started with. That was our just green information that we've got up top. So that just ties to right here, right? That's where we're getting that from. Now, what we now need is our materials requirement per unit. And in this case, we need 0.6 pounds per unit. So that's what we need. Of course, remember, this is in units. So we've got 240,000 units times 0.6 pounds per unit. And the power of doing that multiplication is that we're now going to get this down to the total materials needed for production. This will be in pounds. Because you'll notice that if we actually look at this, what just happened is your units canceled with your pounds per unit. So that gets us down to just pounds, which is exactly what we want. Now, at this point, there's one more thing we'll need. So we don't only need enough production. And if you actually do this multiplication, that's 144,000 pounds. So we don't just need 144,000 pounds, though, because we also need enough that we have 30% of next month's materials requirements available. So what we're going to need to do is add in our budgeted materials ending inventory. And this will be 9,450 pounds. And I'll give you just a second. I'm going to pause the video, see how I figured that out. I strongly encourage it. I think that's a great idea. And then in just 2 or 3 seconds, I'll go over how we actually get that number. So at this point, we're going to go ahead, go over how you get that. So what you're going to have to do is realize, well, during the third quarter, we're going to need to produce 52,500 units. And each one of those units will need 0.6 pounds of materials. But we don't need all of that right now. Does that make sense? We don't need all of it. We just need 30% of it. And we find that 30% in the green box with the yellow highlighting on that last line. So we take the 52,500 times 0.6 times 30%. And when we do that, we get 9,450. So that is how I got the number that we actually see right here, is that 9,450. So we're adding that in. That gives us the total materials requirement in pounds still. 153,450. Okay, 153,450. That's the total amount of pounds of material we will need. But do we need to buy all of that material? What do you think? So I'll give you a second. You can kind of ponder that. And the answer is no. And you say, well, why don't we need to buy all of that in this period? Well, remember that policy, that 30%. We had that policy at the end of the previous quarter also, which means we've already got some of that 153 on hand. So we can actually subtract out our beginning inventory, which of course is also in pounds. And we were told that is 43,200 pounds. I'm going to encourage you to write that in those parentheses so it visually sticks out that, hey, this is being subtracted. This is reducing that total. Now, this allows me to see my materials to be purchased in pounds as that difference of 110,250. 110,250. I do apologize. I'm not feeling super well today, so my voice doesn't sound quite right, and there may be a few blips in the video where I pause it because I don't feel well. But I'll try to get it done as quick as I can. So we're working this through. We've got that 110,250, and now we're going to go ahead and multiply this by my material price per pound. Because here's the thing. And this is the biggest mistake I see students make on a problem like this. Y'all do fantastic by and large, all the way down to right here, right there. And then y'all stop. I don't know why. Because remember, the only budget where it is okay for us to end with anything other than dollars is the production budget. And this is my materials budget. So we have to get this into dollar terms at some point, and we're not there yet. So that means that what we still have to do is multiply by price per pound. Notice what that'll allow us to do. That will allow us to cancel our pounds right there and leave us with dollars, or just our price. That's what we were wanting. Okay. Now, in the text, we are told that the price is $175 per pound. So we can go ahead and do that. And this gives us our budgeted cost of direct materials purchases. And that is what, $19,293,750. So that's what we end up getting. Now, at this point, you are done. This is the final step. If you do not get it into dollar terms by the end, you will not get full credit on the question. Okay, you can't. You didn't do the whole question. You did not prepare the entire budget. So you've got to get it into those dollar terms. That's the key. Get it there, and then you're done. Now, at this point, we are finished. So I'm going to go ahead, erase all of this. Give you just a second to look this over in case you're still writing, or if you're having trouble keeping up, maybe give you time to take a picture. Then we'll go ahead and move on, or give you time to rewind and give you, then we'll go ahead and move on to the next problem. Okay, so in the next problem, we're looking at two budgets. We're looking at our direct labor and our factory overhead budgets. So in this case, we have Addison Company, who budgets production of 2,400 units during the second quarter. And of course, they got that information from their production budget. So we're not going to have to do that because they told us how many units we're actually looking at. In addition, information on our direct labor and variable and fixed overhead is shown below. That's what's in this table right here. For the second quarter, prepare a direct labor budget and a factory overhead budget. Okay, so here we go. For my direct labor budget, which is the first one they asked for, we need to look first at our units to be produced. Remember, this is only able to be prepared once you have the production budget. The question you ask is, well, why? Well, I don't know how many direct labor hours I'll need if I don't know how many units I'm trying to produce. Imagine I ask you, how many hours is it going to take you to get all the production done this week? And you say, well, how many units do I want to produce? Oh, I don't know. And you say, well, then how can I tell you how many hours it's going to take me? Because it's going to be very different if I'm only asked to produce 1 or 2 units versus if I'm asked to produce 10,000 units. That's going to dramatically change the amount of time it's going to take. And so we realize inherently that that is true. So because of that, we need to start back at our units to be produced. We were told that was 2,400. Now, the next thing that we wanted to look at here is our labor requirements on a per unit basis. And of course, remember, this will be in hours. So if we look up in our green table, we are told right here in this blue, each finished unit requires 4 direct labor hours at a cost of $20 per hour. So that's what we're going to need. We're going to need 4 hours per unit. That will give me my total labor hours that we need. Doing that multiplication is 9,600 hours. Now we need our labor rate. This is in, of course, dollars per hour. And we were told that's $20. Now, when you do 9,600 hours times $20 per hour, the hours will cancel. You'll get left with dollars. This will leave you with your budgeted direct labor cost, $192,000. $192,000. And at this point, you're done. This is your final step for your direct labor budget. Once again, do not stop right here. If you stop at total labor hours needed, you cannot get full credit. You must do the cost. You must get this into dollar terms. Okay. Now, the next thing that we want to look at here is our factory overhead budget. And of course, we remember that factory overhead is made up of 2 components. Those 2 components, whenever we talk about factory overhead, if I were to ask you, what is total factory overhead equal to? You would tell me, oh, it has 2 parts. It's got the variable factory overhead, and it's got the fixed factory overhead. And so those are the 2 components that we need to figure out for my factory overhead budget. So when we read through the question, we are told that our variable overhead is applied at the rate of $11 per direct labor hour. So what do I need to start with? Well, I need to start with my total labor hours needed. And you say, well, where am I going to find that? Oh, you mean that's why we did the direct labor budget first? Exactly. It's exactly why we did this. And so now we can pull this down, and that will just tie in to our computation. And for whatever reason, anytime I use this pen or the pencil or the other pen, it messes up my screen. So I'm going to quit using those and try to just stick to the highlighters. I'm not sure if it's affecting the recording or not, but just to be safe, I'm going to stop using those because it's getting longer and longer on that delay each time. So I'm just going to hold off on using the pencil. We'll just try to stick to the highlighter or to the different colors of font in the meantime until I get that figured out, maybe in another video. So at this point, we see that we've got that 9,600 hours of direct labor. We now need to multiply that by our variable overhead rate per direct labor hour. In this case, that's $11. Now, this comes out to give us a total cost here of $105,600, and this is budgeted variable overhead. Now, I will tell you, this budget can be a bit tricky for students because we get in the habit of stopping as soon as we get into dollars. Well, are we in dollars at this point? Yes, we are in dollars. So that's great. But we haven't done the whole budget because we've only considered the variable portion. So we now need to deal with the fixed portion. So we're now going to add in our budgeted fixed overhead. So will be $450,000. And once again, that is just given to us right there. This gives us our budgeted total overhead, $555,000 to $600. And with that, we are officially done with this problem. So I'll give you just a second to review this to make sure you got caught up on everything. Make sure that everything makes sense. And then we'll go ahead and move on to the next problem. Okay, we're going to go ahead and move on. So here in number 3, we are looking at the cash budget. Now, the cash budget can be very lengthy and very challenging. I picked a version for the review that is more similar to the one on your test. The one in the homework is pretty difficult. It's got a lot of individual numbers that you've got to deal with. It's got a bunch of detail that you've got to filter through. This one's a little bit more simplistic, as is the one on your test, just for the sake of time. If I'm going to have you do a 3-month cash budget across all that period, you're not going to be able to do a bunch of individual computations. So because of that, I've gone ahead and I've chosen a problem here that actually gives you total cash receipts. So you won't have to do the cash receipts budget, and you're not going to have to deal with the computation of cash payments. So that portion is done for you, meaning this essentially turns into a plug and chug. Note on the test, I do not think you're given these account titles, certainly. So you will need to know that. But for purposes of the review, I didn't want you focused on writing a bunch of terms. I want you to focus on the format and how things tie together. And I wanted to make sure that you had a good example. So I'm okay with leaving it on the review, but I don't want you to decide that that's all going to be given information for you on the actual test. So here we go. In this case, we're going to look at Kayak Company. They budgeted the following cash receipts, which of course doesn't include any additional loans they may need, and cash payments, which of course doesn't include any cash payments for loan or interest. So, or loan principal and interest. So we will have to still consider a few things, but certainly not to the same breadth that we were doing in class or on the homework for the first 3 months of the next year. According to a credit agreement with our bank, Kayak requires a minimum cash balance of $30,000 at each month end. That is super important. That means that when I come down here to my preliminary cash balance, that better be at least $30,000. If it is not, we must take on a loan. We must take on a loan. In return, the bank has agreed the company can borrow up to $150,000 at a monthly interest rate of 1%, paid on the last day of each month. The interest is computed based on the beginning of month loan balance. The company repays loan principal with any cash in excess of $30,000 on the last day of each month. The company has a cash balance of $30,000 and a loan balance of $60,000 at the beginning of the year. Prepare monthly cash budgets for January through March. So, as always, we're going to start with our beginning cash balance. And in January, we began with $30,000. That was given information to us. Right there in that second to last line, the company has a cash balance of 30 and a loan balance of 60 at the beginning of the year. Now, at this point, we'll need to consider a couple of things. We'll need to grab our $525,000 in cash receipts, and that'll just drop right here. So we'll go ahead and do that. It gives us a total here of $555,000. Now our cash payments, well, in this case, are going to be $475,000. Now that, once again, is just coming from the given information that we have right here. Now, at this point, we've got to consider our outstanding loan. And we were told we have a loan of $60,000 at the beginning of the year. So our loan interest is $60,000 times that 1%. It's going to be $600. Now, I do want to caution you, especially if you don't have me in class, you may not have heard me say this yet, so I want to make sure I say it here. Remember how in probably Accounting 2301, which is Principles of Financial Accounting, we talked about interest. We said interest was equal to three things: principal times rate times time. Well, based on what we just did, I'm seeing the principal was the 60. I'm seeing the rate was 1%. But back in 2301, we always had this idea that we had to multiply interest by this fraction over 12. Or if this was a note denominated in days, we would do that over 360 using what's called the banker's rule. Why am I not needing to multiply this by 1 over 12? So would this be correct? In other words, would 60,000 times 1% times 1 over 12 be correct? If not, why not? And so what we'll find here is there's a fundamental difference in the way the information is presented in this problem to the problems that you saw in 2301. So what I want you to realize is that if you were to do this with this computation, that would be wrong. It would not be correct. And the reason is, notice what they told me in the problem. They say here about our interest rate. The interest is computed based on beginning of month loan balance, and they tell us this is a monthly interest rate of 1%. A monthly interest rate of 1%. It's already on a month basis. The interest rates you were given in financial accounting, by and large, are presented as annual interest rates. So if you owned the money, or if you held the money for less time than a year, you weren't responsible for paying a full year's worth of interest. So we had to basically prorate that down. But in this case, the rate you are given is a monthly rate. So you don't need to worry about that step. That's why you can just do the 60,000 times the 1%. It's not that we don't care about the time anymore. Time's just already baked in the way the information is presented. Now, at this point, we're ready to continue down. 555 minus 475 minus 600 gives me a preliminary cash balance of 79.4. Now, 79,400 sounds great, especially when I remember I only have to have 30. So now I've got two questions I have to ask myself. Do I need an additional loan? Well, is 79,000 more than 30? I think it is. So we do not need an additional loan. We do not. It's zero. Do I have a loan I can repay? Yes. Yes, I do. And the amount of the loan that I can repay is $60,000. So let me ask you, should I repay $60,000 right here? That would take my loan balance down to zero. And that would take my cash balance down to 19,400. So would this be okay? That's my question to you. Would that be okay? And hopefully what you said was, well, no, that's not okay. Because remember, we have to have $30,000. So we can only pay back up to the 60 because that's what we borrowed. But in this case, we do not have enough cash on hand to pay off the full amount. So what we do have enough cash to pay off, though, is $49,400. That comes down to $30,000. That is our ending cash balance. And we now still have a little bit of a loan balance of $10,600. So be careful. A lot of times students will get in a rush and they'll go, oh, I want to pay off the loan, especially if you have more money than the loan balance like we do here. Sometimes we tend to forget about that minimum cash balance. And so don't forget about that. If you were to pay off this full 60, it puts you in a position where you'd be at 19.4. You'd circle back, you need a new loan, that puts you back at 30. Then you try to pay off the loan, then you need a new loan. And you basically end up in this never-ending cycle of loans and paying back loans at the same point in time. It'd be really, really confusing and a really terrible place to be. So don't put yourself in that position. Always remember that minimum loan balance requirement. Or sorry, that minimum cash balance requirement. Now, what we want to recognize is that our next step is to begin the next month. And so what we'll need to do is come in and remember that ending cash balance from January becomes beginning cash balance in February. Now, what I want you to notice here, this is not what happened. We did not just move the $30,000 over from January and call that February's beginning balance. That is not a thing. That is not how this works. It just so happens in this case that the beginning and ending balance for January were the same. But that is not a rule you can rely on. That is not a shortcut. That is not something you want to try. It will mess you up. It will cost you a ton of points on the test. Don't do it. Instead, always remember, ending cash balance for 1 month becomes beginning in the next. And that's where we get this $30,000 from. Now we come up and we notice that our cash receipts and payments are given to us once again. So we'll go ahead, pull those in. That 400 gives us total cash available of 430 minus 350 in cash payments that we already expect. And now we're coming down to February, and we're looking here at February. And remember, our loan payment is based on 1% of the previous month's ending balance or the beginning month's current balance, however you want to look at it. They're the same thing. So just like with our cash, the ending cash balance in January became our beginning cash balance in February. The ending loan balance in January becomes our beginning loan balance in February. So this is just going to be the 10,600 times 1%, which comes out to be $106. Now, when you do 430 minus 350, you'll get 80 minus 106 is 79,894. 79,894. And now the question is, do we need a loan? Well, no, I don't need a loan. I only need to have $30,000, and I've easily got that. So that's zero. Now what we'll do is we'll pay back the loan. And I look and I go, oh, I remember. My minimum cash balance is $30,000. So I bet I can pay back $49,894. That'll get me to $30,000 as a cash balance, and I'm feeling pretty good. That definitely wipes out my loan. Anyone see any problems here? I don't think that's right. Because here's the thing. What that would actually do is give you a very negative loan balance of some amount. I'm not exactly sure. I don't feel like doing the math. But it would put you in a negative loan, which is very strange territory and probably not a spot you want to be in. So instead, what we need to do is realize I could afford to pay back a loan of this amount, sure, but I only owe this much. So that means I can pay back the 10,600. I'll be left with a cash balance here of 69,294 and an ending loan balance of zero. Now, in truth, what you would want in real life is a policy for what to do with this. If I am only required, in other words, to have $30,000 in my bank account, earning basically no interest, then I am not doing my shareholders any favors by keeping that extra $39,294 in this bank account. My investors would be much happier if I took that money, invested it in even a low risk security that's highly liquid, that maybe in next month I need some cash, I can pull out of it. But put it to work for your investors. Put it to work for yourself if this is your own company. Don't just pile all your money in a bank account where it's not doing anything for you. So take that idea and realize that this is a very simplistic cash policy that this company has, only saying, hey, we just pay off loans and then we don't do anything else with it. No, there's some extra steps here that we would want to be seeing worked out in real life. But in here, we kind of stop at this point. So now we're ready to go ahead, roll on into March. And so this right here, ending from February, becomes beginning in March. We're told our beginning, or sorry, not our beginning, our cash receipts are 450, our cash payments are 525. So this is 450,000. This is 519,294. Our budgeted cash payments are 525. And I don't know about you, but I'm not feeling real good about this. I've got $519,000 roughly on hand, and I'm going to have to pay 525. It's not going to work out so well. But do we have any interest this month? Even though it's clear we will need a loan, will I pay any interest in March? And the answer is no. You say, why? Because we will take this loan out on the last day of March. So we won't owe any interest because we will have just taken the loan out. So what we'll see is that the interest we'll actually owe on this loan for March will be due, but it will be due in April, the next month. So at this point, we got no interest. I can say preliminary cash balance is actually negative, but negative 5,706. And remember, we need to be at $30,000. So I'll need a $30,000 loan for sure, but because I'm negative, I need to get back to zero first. So I'll need an extra $5,706 to get me there, which means the amount of the loan I need is the $5,706 to return me to a zero balance. Then I still need 30,000 to get me to that minimum balance requirement. That puts my actual repayment of loan, of course, at zero because we're not going to repay anything here. And that gets my ending cash balance to exactly what it needs to be, 30,000. And my ending loan balance to 35,706. 35,706. Now, I'll be honest, this took us a while in this video. We walked through it very slowly. We talked about a lot of things here. By test day, I would say you need to be able to do something like this in about 10 minutes. If it's taking you much longer than that, I think you're going to struggle to finish the test. I really do. If you can get done with this in 6 or 7 minutes, fantastic. I mean, that's awesome. But I will say, be careful. If it takes you 11 or 12 minutes, but you know it's right, it's worth it. Because if you make a mistake over here in January, it's going to mess up some stuff in February, which is going to mess up some stuff in March, and it's going to turn into a really bad situation really, really quickly. So don't do that. Make sure you get it right, but also make sure you really prepare for this question. You know it's going to be on your test. And so take the time to understand how all of this is tying together and make sure that by exam day, you're getting this thing done and you're not wasting any time on. I think it's worth right now 15 points. That may change in a future semester. If it does, it'll be on the breakdown, of course. But I believe this is a pretty heavy question. So take your time, get it right, but don't waste time. Don't sit there like, don't even know where to start, right? If you're at that point on exam day, you're not going to finish the test. You're just not. You're going to have to know how to approach these things and knock them out pretty efficiently if you want to be able to get through the exam. You're just going to have to. So keep that in mind. All right. At this point, we are done with this. Technically, all of these are final numbers. So if you want to hit them all with double underlines, you can. But that's the end of this one. So I'll go ahead. I'll zoom it out for just a second and let you kind of get one last look at all of the information for this problem all at once. And then we'll go ahead and move on to number 4. Okay. With this, I'm actually going to go ahead and knock out all of our drawings just to clean that up a little bit. And now we're ready to go. Now, for our next problem, we're going to be looking at what's called a flexible budget performance report. We did one of these in class and it was long. Man, it was long. We did a bunch of different stuff. And this one is much shorter. The one on your test is a little bit shorter than the one we did in class also. So it should be doable, certainly fairly quickly. But we do want to walk through how this works. The good news is you're going to get one of these columns exactly right with very little thought required, as long as you know how to start. Because the actual results, they're given to you. They have to be. So that means that this whole actual column, you're not going to have to do any thinking at all, as long as you know the order of the accounts on the side. So here we go. We're going to look at our flexible budget performance report. We're going to start with sales. And we're going to note that in this problem, this operates at a level of 10,800 units. So if we read through the question, it tells us Zion Company budgets a selling price of $80 per unit. So I'm going to say budgets a selling price of $80 per unit, variable cost of $35 per unit, total fixed cost of $270. During June, so I'm going to switch colors because it's actual stuff. During June, the company actually produced and sold 10,800 units and incurred actual variable costs of $351 and actual fixed costs of $285. Actual sales for June were $885. So we've got all of our information. We got it nice and color coded so we can keep up with the budgeted stuff's in blue, the actual stuff's in yellow. Prepare a flexible budget report showing variances between budget and actual. Okay. Then of course we need to identify fixed or favorable or unfavorable in this outside column. So based on the information we've been given, it looks like we're being basically asked to do a variable income statement. So let's go ahead and set that up. Sales minus variable expenses. And we know that sales minus variable expenses equal gross profit. Is that right? Is that right? I don't know if that's right. Sales minus variable, that doesn't sound right. So maybe that's not. What do we think sales minus variable expenses is? Do you know? Hopefully you know at this point in the semester, this is contribution margin. I like to make the mistake of labeling that as gross profit though, because it is a mistake students make all the time. Every semester I see it, not only on exam 2, which is where it's extremely common, because you're being asked to prepare both absorption and variable costing income statements at the same time. So it's easy to get those things mixed, but we also see that same mistake popping up on exam 3. And so you want to be extremely, extremely careful. You want to be extremely, extremely careful. And so we're going to go ahead and take sales minus variable expenses and contribution margin. And so in this case, once we've done that, we now need to take out our fixed expenses, and that will give us income from operations. Income from operations. And now it's just a matter of pulling in our information. Now, I'm going to suggest you go ahead and knock out the actual column first because it's given. We were told actual sales, 885. Actual variable costs, 351. That difference, pop it in a calculator real quick, 534. Not 554, 534. Then we were told actual fixed expenses, 285. And that comes down to 249. This is why I tell you, one of these columns, there is no reason you don't get all the points for that column. Even if you mess up the flexible budget, which may be a little bit more challenging, but not much. I'm sorry, certainly not much worse, but there is one extra step we got to deal with. But there is no reason we don't all get the points for the actual column. Now, for the variable or for the flexible budget stuff, what we want to do is I'm just going to set up a situation down here, or a section down here in my notes called computations for flexible budget information. Just to help me realize, hey, this is where I actually am getting these numbers from. So my sales, well, that's going to be equal to, it told us we budget the selling price of $80 per unit. And remember, my flexible budget takes that budgeted selling price and multiplies by the actual number of units sold, 10,800 units. That's going to come out to be $864,000. Now, my variable expenses, since we need both of these, we might as well do them together. Well, we were told that was budgeted at $35 per unit times, and once again, the actual number of units, 10,800, $378,000. Now, what I'm going to do, I'm going to make these just two different colors just to help us visually see what is happening. So we're going to go ahead. We're going to make the expense red. We're going to make the revenue blue. That's fine. So the sales will be coming right there. The variable expenses will be coming right there. Go ahead and get your dollar sign back in. Now, at this point, 864 minus 378, that'll give us our contribution margin of 486,000. Now, our fixed expenses, we were told in our budget, well, that was $270,000. I'm just going to make a note of it down here so I have all of my information together. 270,000, and I'm going to actually remind myself that was given information. It's given. So just to be consistent, I'll go ahead and I'll give this a color. We'll just give this one green. That's fine. So we'll pop that in as 270. And now we're ready to go. 486 minus 270 is 216. And now we pop out our variances. So be careful with your sales variance because 99% of the variances, maybe not 99%, but a huge majority of the time we spend in class and in the textbook and on the homework is looking at variances with expenses, which works a little bit differently than variances with revenue. So we've got to be careful to remember that sales is a revenue account. When I'm dealing with revenue, I want actual greater than budget. So $885,000 in actual sales revenue versus only budgeted sales revenue of $864, the difference is $21,000, and that is a favorable variance. Now, for my expenses, I want actual less than budget because that means I did a better job managing my costs. So in this case, with my variable expenses, actually I spent $351. I planned to spend $378. That's a variance here of $27,000, and it is also favorable. Now, two ways to get this next one. 21 plus 27, since they're both favorable, you can add them. $48,000. And since they're both favorable, of course, that's favorable. The other way is to look at your contribution margin. We like contribution margin. Contribution margin is the amount that is left over from my sales once I've paid for all my variable expenses. I want that as high as possible. So if actual is higher than budget, that's a good thing. 534 minus 486 is 48,000, and that is favorable. Now, for our fixed expenses, we've got $285,000 versus only 270 budgeted. Well, that's a difference of 15. And because this is an expense and we spent more than we wanted, it's unfavorable. Now, at the end, we can net out the 48 and the 15 and get $33,000 favorable if you want to do that. Or you could always look here. We like income. 249 in actual income versus only 216 in budget. Well, that's 33,000 better off. That's a favorable variance. And so that is how we handle our flexible budget performance report. The only extra wrinkle you might see on the test here would be if I did not give you the 80 and the 35 and I made you solve for them. And I said, we expected flexible budget amounts of X amount of dollars for sales and variable expenses at this level of production. We actually produced at a different level. You didn't have to deal with getting all that down to a per unit basis and multiplying it out. But it's just one extra step, and we've done it in class. You've done it on your homework, I believe. So you should be fairly comfortable with that. If that sounds like something you're just like, I don't know if I'm going to know how to handle that, reach out to me. I'll be happy to help you with that. It's just not part of this problem. So we're going to ignore it for now, but be aware you might see that on the test. I honestly don't remember if that's how the problem is listed or not, but I know some of the problems we've worked have been like that. So certainly something to keep an eye out for. Okay, with that done, we're ready to go ahead and move into number 5. So here in number 5, we're going to look at our direct materials and direct labor variances. Now we're going to look at materials on the first page and labor on the second page. Because of the way that I like to set these up, it takes up a ton of room in Word, which means that I can't fit both of them on the same page. I do believe that at least in my class on your test, I'm going to have you entering the information into something that looks like this, which is why I want to be sure to do this in the review video. Truthfully, there are formulas for all of this stuff. We've derived them in class. You can find them in your book. That's great. If you like the formulas, you can certainly use those to check. But unfortunately, to get the points, it's going to have to be formatted like this because that's how the software that we're currently using actually grades this. If we're ever not still using Connect for whatever reason, I know once I post this video, it'll be up forever. So if at some point that changes, then we might be doing something else. You know, it might be tested a slightly different way, but at least at the time of this recording, this is how I'm going to be testing it. This is how you're going to have to enter the information on the test. So here we go. Hutto Corporation has set the following standard direct materials and labor costs per unit for the product it manufactures. We've got our direct materials information here, $15 or 15 pounds at $4 a pound. Our direct labor information, 3 hours at $15 per hour. And of course, this is my standard information. This is my standard, right? I'm going to do this in blue because I like the idea of blue being budget. All right, so this is basically what we're budgeting for. During the month, the company incurred the following actual costs to produce 9,000 units. Now, before I do anything on a variance problem, anything else at all, I always recommend that you do this little top section. It is not actually a required part of the test, I don't think. But man, it's going to make your life so much easier. If you get into the test and you're struggling toward the end of one of these variance problems, having this basic computation done at the beginning is going to help you make sure you don't make a silly mistake, either in interpretation or you write something down wrong or you get something weird happening. And so here we go. I'm going to walk you through how this is going to work. And so what we're going to do, we're going to look at our actual quantity times our actual price. Because what we realize is that at its most basic level, a variance is simply the difference between what actually happened and what we plan to have happen. That's it. So what we're going to do is before I even break down into the subcomponents of price and quantity, I want to get the overall variance. Then once I have that, I can take this number that we'll end up with, put it right here, and then I can check myself at the end if my two component variances don't tie back to this. I know I've made a mistake. And so it gives me a really nice self-check. And we'll notice that what we're about to do in here is actually two components of our bigger picture anyway. So it's not even any extra work. It's stuff you would have to do anyway, and it gives you a check. How much better value can you get on an exam than that? That is super efficient. So it's why I strongly recommend that you do this. Okay, here we go. I'm going to be doing a ton of color coding text in this section. So we're going to come in. We're going to do our actual quantity in red, just so it'll be track easier down through the picture below. It'll be easier to follow if everything's an actual quantities in red. And we're going to multiply that by our actual price. We're just going to do our actual price in black. That's fine, $3.75 per pound. And this, of course, is 138,000 pounds. Okay, that's our first step. And you'll notice that that's right here, right? It's just that. And that's $517,500. Next, we want to compare this to our pure budget. Our pure budget is going to be our standard quantity times our standard price. So our standard quantity, I'm going to do in green. Well, my standard quantity, if I look at it, I go, well, quantity 15 at 4. Okay, so 15 times 4, and I get 60. Anyone feeling a little bit bothered by that? It looks a little bit weird for me to be comparing $500,000 to 60. I don't think that's right. So maybe we've got something going on here. And once again, I make this mistake here on purpose to show this is something I have a handful of students do every semester. And we forget that sometimes just backing up and looking at things for reasonableness is a really great method to prevent us from doing something silly like this. So what we want to realize is that the standard quantity, you got a little bit of math to do. Notice we actually produced 9,000 units. Each one of those units should have used 15 pounds of materials. That comes out to 135,000 pounds. That 135, that is what we want for my standard quantity. So that is what we will pull right here, 135,000. Now we'll multiply that. Let's go ahead and get us back to just black for a second. Times, and then what we need now is my standard price. And remember, our standard price was given to us right here as $4 per pound. So $4, and then of course per pound. So per pound. Okay. And when we do that, what we're going to come out to here is a total of $552,000. And I'll be honest, I feel a whole lot better comparing those two numbers than I do 517 to 60. That just didn't feel right to me. Did not feel right at all to compare $500,000 to $60. Not even 60,000. $60 by itself. That just didn't feel right. That made some alarm bells go off in my head that I thought maybe we missed something, and we forgot that we had to multiply that by the 9,000 units. And so what we end up getting here is our total cost variance. And this comes out to be $34,500. And now we just have to interpret that as favorable or unfavorable. Actual 517, budget 552. We spent less than we expected. That's favorable. That's favorable. All right. Next, we've got our direct materials price and quantity variances. Now, this is the method that I always refer to as the pitchfork method. Evidently, that's not a widely used term. I don't know. I may have read it somewhere, or maybe I came up with it myself. I have no idea. I'm not trying to take credit if it's already a term that is officially used somewhere. But I find that a lot of people don't agree with the naming of this as the pitchfork. But to me, that helps me remember that, okay, this is really just a picture that we're working with. And so what we're going to see is how this picture is going to help me take that 34,500, break it into its two components, and give management actually useful information for making decisions. So here we go. What we want to compare, and this is the order that I always recommend you do this in. Put actual cost on the left, that's pure actual, and put standard cost on the right. Then I recommend that you always start with quantity. So actual quantity on the left times, and then actual price. On the right, on the far right, you'll come in, you'll do standard quantity, which you'll remember that was our green. So we'll set that up, standard quantity times, and then our standard price was our blue. So times standard price. Now, the reason I recommend that you set this up in this way is notice what just happened. You've got your 517, it just drops right there. You've got your 552. It can just drop right there. Wait a minute. I've got a math error. Holy cow. I can't believe I did that. I just caught it mentally and I thought, this isn't 552. I'm so sorry about that. This is 540,000, which gives us 22,500 as a favorable variance. Then this is 540. I got the 552 in my head because it eventually ends up in the middle. So I guess from working this problem earlier, I just remembered eventually we get the 552. But I did catch it just now and I thought, whoa, 135 times 4 is definitely not 552, it's 540. So we got that. So I do apologize for that typo there for a second. But basically what we're going to be able to do at this point is if you want, you can take that 22,500, drop it down and realize this will be your total direct materials cost variance. Now, what's going to go in the middle? And here's why I recommend that you do the stuff in the order that I suggested. If you start with actual quantity on the left, then when you build out your flexible budget in the middle, the leftmost part from the left comes into the middle, and the rightmost part from the right comes into the middle. To me, that is so much easier to remember than just trying to memorize what actually goes here in the middle. So with that drawing done, I'm going to go ahead, I'm going to undo those just to get them out of the way because those are drawn on with Zoom and they'll move around as we move the screen. So I don't want that happening. So I'm going to get rid of them. But that's the logic. That's the reason I'm telling you, write it in this order. It will make it much easier for you to remember. Now this builds out your flexible budget in the middle. So we'll go ahead, we'll get that in black just so you can tell what's going on here. This is my flexible budget. Then you remember, this is really my actual quantity times, we'll pull that, my standard price and pull that. That is why I recommend that you do things in the order that we've seen them. Now, this is real easy. Well, actual quantity, 138 times actual price, 375. That's your 517. Standard quantity, 135 times, oops, let's get that back in the green as it's supposed to be. So 135 times. And then in our blue, we'll have our standard price. And our standard price was $4. And that's the 540. Now, that allows us to see that this 138,000 can just come straight on over times 138,000 times, and then we've got our $4. That is where we get our 572 from. Oh my goodness, our 552 from. I don't know why I'm having so much trouble with that number today. All right, that gets us set up. Now, what I recommend you do for interpreting this section here is, and this is contrary, I believe, to the way your book does this. So if you don't like what I'm about to do, you can do it the way the book shows you. To me, the way the book does this is a little bit confusing because the book will subtract things from left to right, but then your signs are backwards. And what I mean by that is if you subtract left to right, then a positive is actually unfavorable and a negative is actually favorable. And that just seems a little bit counterintuitive to me. So I don't like that direction for my expense ones. So what we're going to do instead is we're going to subtract right to left. What this is going to allow us to do is say, if I get a positive number, then I have a favorable variance. If I get a negative number, I have an unfavorable variance. I have an unfavorable variance. And so to me, this logic is much easier to remember. because positive sounds good, negative sounds not so good. And so it helps me more consistently interpret these correctly. So that's why I recommend you move right to left when we're dealing with expenses. So in this case, 540,000 minus 552. Well, when you do that, the actual numeric value you will get is 12,000. So that's the first piece. That's 12,000. If you stop at 12,000, it's wrong. It's just wrong. You don't get any credit for it, I don't believe. Because you have not told me the most important part, which is this a good thing or a bad thing? Well, notice 540 minus 552, that gives me a negative. And we said when we get that negative, we interpret that as unfavorable. Now, this is, if you look at what's actually changing in these two, notice how they're both being multiplied by standard price. But notice the quantity is different. This is my quantity variance. And it should not be at all surprising that came out to be unfavorable. And you say, well, how would I have known that it should be unfavorable? Well, you actually used 138,000 pounds. You were only supposed to use 135. You used too much material. That means this is unfavorable. And that's how, before I even looked at the math, I knew this sign had to be unfavorable. Now, continuing our right to left subtraction, we'll now compare 552 to 517. When I do that subtraction, 552 minus 517.5, I'll come out with a total here of 34,500. And I get a positive 34,500. So that is favorable. And this, of course, if you notice, quantity in both of these is fixed. And what's changing is my price. So this is my price variance. Now, what we just saw here was that we could have known this was going to be favorable before we even did the math, because I see I actually paid $375 for something I planned to pay $4 for. This means I saved a little bit of money. I like saving money. That's favorable. Now, what I want you to realize now is to get your total cost variance, you, in this case, net these two out. So you have 34,500 minus, so this is what's really going on here. You've got a $34,500 favorable variance compared to a $12,000 unfavorable variance. Now, what that means is those two things are going in opposite directions. So that unfavorable variance is going to eat away at a piece of the favorable variance from above. So what we end up with here is $22,500 favorable. That's how that math actually works. And that's what's actually going on here. And the story that's going with this is basically, hey, or what I would imagine would be a good story to go with this in real life is, all right, we used more material because we bought a cheaper product. Buying the cheaper product saved us money on that side, but because it was cheaper, we either had more quality defects or we had more substandard items and it broke more often, whatever it is, but it caused us to use more material. And so the question our management has is, was it worth buying this inferior product and using more of it? Or maybe would we have been better off buying the normal product at $4? You know, or maybe there was something else, but this is certainly a very plausible situation that you could see happen. And in the end, in this case, we would say, yes, it's actually a good thing that you did this because we ended up with a favorable variance. We ended up with a favorable variance. Okay, so that one's done. Now, at this point, we're going to deal with our direct materials and direct labor variances. And in this case, we have Hutto Corp, who has set the following standard direct materials and direct labor costs per unit for the product it manufactures. So notice in this case, we're going to be looking at materials and labor. So we just did the materials part. We're now doing labor, right? So it's a continuation of the previous problem. We're just now doing the other side of it. During May, the company incurred the following costs, blah, 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 all that stuff's the same. Just like we did before, I'm going to strongly recommend that you do this little piece up top to help you stay organized. So what we're going to do, we're going to compare pure actual actual hours times actual rate per hour. And in this case, our actual direct labor hours were 31,000 times $15.10 per hour. When I do that, this is 468,100. And this 31,000, that's my actual hours. I'll go ahead and make that red, just so it's easy to follow down into our table in a minute. Now, next we're going to be dealing with our standard hours times our standard rate per hour. And in this case, that's 27,000 hours times $15 per hour. And you say, well, that's great, but Mr. Allen, where did you come up with the 27,000 hours? I don't see that given to me. And you're right, it's not given to you. That's actually what this asterisk here is for. This will end up being green in just a second. So we'll go ahead and do that. But I want to give you just a minute after we've seen how this works on the other one to see if you can figure out where that 27,000 is coming from. So I'll give you just a few seconds, and then I'll hop in and actually show you where that's coming from. Okay, at this point, what we're going to do, we're going to take our 9,000 units that we need to produce, or that we actually produced, times the 3 hours per unit. That's how much time it should have taken. That gives me 27,000 hours. That is where this 27,000 came from. Now, when I do 27,000 times 15, I'll come out to $405,000. That'll give me a difference here of 63,100. And of course, that is unfavorable. That is unfavorable. Now, it's unfavorable, of course, because actual 468 versus budget of 405. It's not good. Now, what we end up with, this is our total direct labor cost variance. And where did we say on the last problem we could immediately take that and lock it down? So I'll give you a second. Hopefully you said, oh, it goes right here. It goes right here. That is my total direct labor cost variance. Now, if you're ever trying to do one of these problems, and let's say you either don't have me in class, or maybe you're not even one of my students, you just found this video, you're struggling in managerial accounting, and your professor doesn't give you this table form. If that's the case, then you can absolutely set this up on your own, just in blank space. It's exactly how I work it on the board in class. But what you're going to do is, and I will do it this time just with the pen on the bottom here for direct labor, but it would work the same way for materials. Your terminology would just change a bit. So what you would do is you would start here with your actual hours times your actual rate. On the far right, you'd have your standard hours times your standard rate. And once again, I always recommend writing those two down first. It then allows you to see clearly this will pull over to here. This will pull over to here. So our middle, our flexible budget will be actual hours times standard rate. And that's what we need. Then you'll work everything out. You'll come down to some numbers, whatever they are. I'll just put some parentheses here, just indicating, all right, we should have numbers. Then you compare right to left. And doing it right to left, once again, will allow you to see that if I get a positive number, that's a favorable variance. If I get a negative number, that's an unfavorable variance. That's why I strongly recommend when we're dealing with the cost variances, go right to left. Now, you'll notice that what we have here, and I'll get a different color for this because I'm going to derive some formulas here. But when we're doing this comparison, notice there's a standard rate in each. So I can actually factor that standard rate out and then multiply by the change. And I recommend doing your standard hours minus your actual hours. Once again, a lot of textbooks like to switch what's in that set of parentheses to have it actual minus standard, and that's fine. But the problem is it makes your signs funny. Here, this is what I budgeted for. If I budgeted for more than I actually needed, this set of parentheses is positive. Times a positive number will give me a positive answer. That's favorable. We're good. You get that weird sign flipping thing going on if you leave it actual minus standard, which is why I recommend go ahead and flip that around, have standard first, subtract out the actual, and that should help you with that a little bit. This is what we call our efficiency variance. With labor, it's called an efficiency variance. We don't talk about quantity variances with labor because we don't talk about what quantity you work. We talk about if as a worker you are efficient or inefficient. So this is an efficiency variance. On the other hand, we're going to come in and we're going to notice that each of these terms has actual hours. So we can pull out actual hours, multiply by the difference between the standard rate and the actual rate. Notice what's changing here is what's in the parentheses. This is my rate variance. That is all we're doing here, okay? And the reason I call this a pitchfork is because when I draw it in class, I'll draw it like this. And to me, that looks kind of like a pitchfork, especially if you were to actually draw this down. I don't know, it kind of looks like a pitchfork. So it helps me logically make that connection. And even if you don't think it looks like a pitchfork, that's okay. If you think it looks like something else, great. The idea is to hopefully give you a visual cue that you can snap into and go, oh, okay, I know how to handle this. I know how to set this up in a way that I can tackle this problem. So me personally, I do not use these formulas. I don't. If you come to me and you ask me for help with variances, I can tell you right now, 99.999999999 times out of 100, I'm going to tell you draw the picture. It is an extremely rare circumstance where I'm actually going to refer you back to these. I think they're useful, but to me, I am such a visual learner that for me to process something well, it really is helpful if I can see it. And these pictures do a great job of that for me and hopefully for you as well. So let's go ahead and get back on track with the actual problem. I'm going to erase all this stuff we just did down here, but that's how I would really set this up on notebook paper or on a piece of maybe printer paper if I were working this without this document. So in this case, here we go. All right. Now, we're going to set this up just like we did before. We want actual cost all the way on the left. We want standard cost all the way on the right. I'm going to go ahead and come back and just grab all of this, honestly. A lot of this is about to change, but just so I don't have to redo all of that formatting, that way all of my colors will be in the right spots. And then I'll just change out the stuff we need. Now we have quantities become hours, prices become rates. So all the Q's become H's and all the P's become R's. And I think this is really helpful for you to see that there's really not a lot of difference in how this works. Now, on the pure actual side, what we saw was that we actually used 31,000 hours, and we actually paid a price of $15.10. In the middle, we have actual hours of 31,000 and an actual rate, once again, of $15. Sorry, a standard rate of $15. I misspoke. See, this is why I always tell you, do the outsides first. Do the outsides first, so it'll keep you more straight. I tried to shortcut it and made a mistake for a second. So don't be me, all right? Be better than me. Now, for our standard hours, we're going to look back and we're going to see that that's that green number we had. And that was at 27,000 hours. So we're going to go ahead and pop that in, 27,000 times, and then our standard rate is 15 bucks an hour. Now, what I strongly encourage you to do is before you even do any math at all, look at what's going on here. Standard hours, 27, actual 31. Took me longer to do the work than it should have. That doesn't seem like a good thing. I think that's going to be unfavorable. And over here, I look and I go, okay, we were supposed to pay $15 an hour. We actually paid $15.10. That doesn't seem favorable either. We actually paid more. That seems unfavorable. So what I'm going to decide here is before I do anything, I even see the math, I know I'm getting two unfavorable variances, which means that I know this will have to be unfavorable. And so far, it seems like we're on the right track. Now, it could also happen, not in this case with our specific numbers, but it could happen that one of these is favorable and you still end up with an unfavorable. That just means that the unfavorable is stronger than the favorable. That's fine. But in this case, if I've got two unfavorable things that I'm adding together, it definitely makes sense that my final answer is unfavorable. What I could not see happen, in other words, is these two be unfavorable and this be favorable. That would not make any sense, right? That would be a clear logic mess up, right? A clear logic error that we would want to correct. So in this case, here we go. 27 times 15, we already did that. That's 405. The 31 times 1510, we already did that. That's 468, 100. 31 times 15 is 30 times 15 plus 1 times 15, which is 465. Now, at this point, what we do, we compare right to left. 405 versus 465. That is a $60,000 variance. And it's actually negative, unfavorable, 60,000. On the other side, 465 minus 468, 3,100. And once again, we get a negative. So we end up with unfavorable. Notice 60 plus 31 is 63. And that works out exactly to what we expected it to work out to. Because here's what we're essentially doing with that shortcut at the beginning where we're jumping right to, and let me get my pen to work here. Or we're jumping right to filling this in. We're essentially saying, hey, we fundamentally recognize that a variance is the difference in actual and budget. And at the end of the day, that's what my total variance is. It's just that difference in the two extremes. We need that middle piece to get us the actionable information management needs to determine where the actual problem is. I mean, out of these two, they're both unfavorable, but I think it's certainly safe to say this is the variance that I'm much more concerned about. Right, that $60,000 variance is a much larger concern to me than a $3,000 variance. It's not that I don't care about this. If I can figure out what happened and caused that, yeah, I'll probably try to fix it. But if I've got to pick one, this is the one I'm honing in on out of those two. Okay. Very good. So I'll give you just a second to look this one over, and then we'll go ahead and move on to our next problem. And at this point, we are just about halfway done. So congratulations on making it this far if you've been watching the whole thing. We're going to try to keep it exciting and entertaining through the last half. As you all know, I love accounting. I never get sick of it. You may well be sick of it at this point or be getting there. If you need to take a break, this is probably a pretty good spot to take a break. You might decide to go ahead and work through this one. Would probably be better because this is the end of 21. The next problem will take us into 22 review. So if you were to stop after this one, that'd probably be fine. But you know, always come back, right? Finish the video if you need it. Make sure you're taking advantage of this resource. I think it's going to be very helpful, hopefully, for a lot of you. So in this case, we're looking at sales variances. And I want to make sure you realize we are looking at sales variances. Sales variances. Notice, not a cost variance, a revenue variance. That means things work a little bit differently. And this is so easy for us to see back when we did our flexible fixed budget or our flexible budget performance report, where we said, oh yeah, it makes sense. Actual revenue greater than what we expected, that's favorable. We like that. It's so easy. But when you've been in the middle of doing all these cost variances and you roll into a problem on sales variance, if you're not careful, you will interpret these the same way as your cost variances and you will get everything wrong. So be extremely careful when you get to sales variances. So here we go. In this case, for my sales variances, we are told in a recent year, BMW sold X number of Series 1 cars. Assume the company expected to sell this many cars. Also assume the budgeted sales price for each car was 30 and the actual sales price was 30,200. Compute the sales price variance and the sales volume variance. Okay, what I'm going to recommend you do, first of all, just use your highlighter if you can. If you can't, you can't. But I'm going to use it to just identify my different pieces. So once again, we're going to use blue for the budgeted stuff. So we expected to sell that many units, and the budgeted sales price was that. And once again, I'm going to use yellow for actual. So yellow for actual. In this case, we actually sold. So we actually sold that many cars, and the actual sales price for each car was that. So we've got our information nice and labeled. And now, once again, I'm going to recommend you build the overall variance out first, then break it into its two pieces. So here we go. Actual units times actual price. This 182,158 times 30,200. And just as we've been doing, I'm going to go ahead. I'm going to make this number red, just so it's easier for us to follow through in the math below. This gives us a really nasty number, $5,501,171,600. Now we need to compare that to standard units times standard price, or budgeted units times a budgeted price. In this case, that's 191,158 times $30,000. See if we can fit our parentheses. Didn't quite fit. Okay, that's fine. We'll adjust the margin just a little bit. And as always, we'll go ahead, we'll make this number right here. I believe we've been doing this in green, and I believe we've been doing this in blue. Truthfully, it doesn't matter if it's not the same problem across problem, but I try to be as consistent as possible to make it easier to follow. So $5,734,740,000. That's what we come out to there. And in the end, we get total sales variance. And this is 233,568,400. And now the question is, favorable or unfavorable? Well, actual revenue that we got was this. Budgeted was that. Looks pretty unfavorable to me because we did not generate as much revenue as we wanted. Now, the issue at hand here is if you look through the problem, notice what was really happening here. We expected to sell more cars at a lower price. We ended up selling less cars at a higher price. And the question is, which of those two things is more powerful? Which of those two things is more powerful? So we've got to be careful. Here we go. In this case, we're going to go ahead. We're going to look at our actual cost. And once again, I'm just going to come up here and grab this and I'll just adjust as we need it. But this way, hopefully most of our formatting stays consistent for us and we don't have to worry about jumping back and forth. So in this case, we'll have actual units times actual price. And then of course, this will be actual units times budgeted price. And then here we'll have budgeted units times budgeted price. Now we'll start with the left. So on the left, how many actual units did we sell? 182, 158. I'll zoom up just a little bit so you can hopefully still see the actual information we're working with. So 182, 158. And we actually sold each car at $30,200. On the right-hand side, we planned to sell 191,158 units. And we planned to sell each unit at a price of $30,000. This gives us 5,734,740,000. And of course, on the left-hand side, you have 5,501,171,600, just as we got before. Now, in the middle, remember, we'll pull our actual units from the left, that'll come in, and our budgeted price from the right, and that will drop right there. Now, this gives us in the middle $5,464,740,000. And at this point, I am feeling honestly pretty grossed out with these numbers. I'm not a fan. These numbers look pretty nasty, especially compared to what we've been working with, right? These are not easy to compare numbers. But here's the trick, and here's what I strongly recommend that you do. It is much easier, just much quicker even, to compare at this level than it is at this level when you're trying to determine favorable or unfavorable. So notice what's staying the same. In this case, our price is staying the same. Oops. This will, of course, be actual units. Our price is staying the same, but our units are changing. So this will be our sales volume variance. And I can look at that and go, well, we planned to sell 191. We only sold 182. This must be unfavorable. Must be. On the other hand, I look, my units are fixed, but my price is changing. So this is my sales price variance. And I go, well, we sold at a higher price than we expected. This must be favorable. And that will help me get my favorable and unfavorable. And it'll be so much easier than dealing with the math. Now, you will still have to do the math to get the actual numbers. But sometimes when we get really weird numbers, it messes up our abilities to do the easier stuff, which is the interpretation. So do the interpretation first if you need to. You can do that before you do the nasty math. Now, when you do the nasty math, you're going to come out with a variance here of $270 million as your sales volume variance by comparing these two numbers. And you'll notice 5,734 minus 5,464 gives us a negative, and gives us a positive. And this is why I say sales variances are weird. If you use the same trick, that right to left that we've been using on our expenses is going to confuse you most likely. Because here's the thing. Remember how earlier we said with revenue, we want actual greater than budget. But with expenses, we want actual less than budget. Well, we set up all of our stuff to help us with the expenses because we deal with those so much. But now that we're dealing with revenue, it might make sense to actually go left to right if you want. But to me, trying to remember, well, I go right to left sometimes and left to right other times, that's very confusing. So what I would rather do with my sales variances, or maybe even all of my variances, truthfully, is just do this for the number, whether you're doing right to left or left to right, doesn't really matter. Then use your intuition by looking at what's actually changing and determine the sign. Don't so much rely on a trick, as you may call it, as logic, right? Accounting, so much of accounting is logic. And if you can find the logic to what's happening, you don't need a fancy trick. You can say, oh, this is, in this case, unfavorable because we sold less units than we expected. Unfavorable. Now, on the other hand, we're looking at our sales price variance. The difference in the 5,464,000 and the 5,501,000 is 431,600, and that is a favorable variance. And this is my sales price variance. In the end, when we net those two out, we'll come out to 233,568,400. And it should not be a surprise that's unfavorable. 270 is certainly a lot greater than 36. So the unfavorable outweighs the favorable, leaving us with the unfavorable. And notice this number is the same number that we got up top. In the end, we knew that's what we should be ending at. And this is our total sales variance. Our total sales variance. Okay, at that point, we are done with chapter 20 and 21. Those are probably the two longest. 22 has one long problem, and it's actually the first one that we're going to be doing here. So like I say, if you want to take a break, now would be a really good time to do that. Make sure your mind is fresh and sharp for the next part. So either pause the video, hop off for a little bit, maybe take a 10, 15-minute break, go get a bite to eat, do something, and probably come back if you're starting to zone out. If you're with me, if you're in it, stay in it. Let's keep going. We got this. But if you need a break, take it now, because these next two problems take us a little while. And you're going to want to be on your toes to make sure you don't mess this up on your test. So here in 22, first thing we're looking at is service department expenses that are allocated to operating departments. What we're essentially trying to do is say these service departments, while important to the company, I'm not trying to say they're not important. They are important to the company. They don't generate revenue. So what we're trying to do is take the money from the departments that do not generate revenue and allocate it to the departments that do generate revenue. And that way we get a better look at how things are all actually tying into our revenue, makes us feel like we've got a better idea of our company. So here we go. First thing we want to do is just read through it. So the following is a partially completed lower section of a departmental expense allocation spreadsheet for Cozy Bookstore. It reports the total amounts of direct and indirect expenses allocated to the 5 departments. Complete the spreadsheet by allocating the expenses of the 2 service departments, which are advertising and purchasing, to the 3 operating departments. And of course, that's books, magazines, and newspapers. So we see that information given to me in this table. It's a little bit hard to see, so I'll zoom in really tight and close for a little bit. I strongly recommend, if you're following this video, go ahead and take a picture of this if you want. It'll just help you know where these numbers came from in a little bit. But basically, all we really need from this table is this top row. But if it makes you feel better to have the picture, go ahead and take the picture, have it as we work through this, and it might help you feel a little bit more confident about where things are coming from. So in this case, we're going to take that top row of information. We're going to go ahead. We're just going to pull it all down. This is 698,000. That's the total. And then it tells me we've got 24,000 in advertising, 34,000 in purchasing. Books have 425. Magazines have 90. Oops, I guess I need all the zeros. And then newspapers have 125. Now, I want to tell you something super important. When you get to the end, the total amount that will be allocated to operating departments, I'm going to give you a trick here, or a hint. It's going to be the 698. It has to be the 698, because that 698, we're still dealing with the same information. We're just partitioning it out differently. So what we're also going to find is that with my advertising department, they tell us advertising depends on the basis of dollar sales, and then purchase orders is our allocation for the purchasing department. So what we're going to find here is for my advertising department, my allocation base is sales. For purchasing, this is purchase orders. And what we're going to hopefully find is that through this process, we're actually going to zero out my advertising department and zero out my purchasing department. That's what we're trying to accomplish in all of this, is get those costs that are currently in advertising and in purchasing and allocate them across the other three departments based on their usage of advertising and purchasing. That's the goal. That's where we're headed. And you can notice before we've done anything complicated, we've got well over half this thing knocked out. All we've got left really are a couple of things right here. Well, right here, just these 6 things. And then we'll of course deal with this. We got 9 things left, but look, we've already got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. We're close to 2/3 of the way done with this thing now. So that's awesome. So take advantage of the information you're given, knock out the easy stuff first, then deal with the more complicated stuff. And thankfully, the more complicated stuff in this case isn't super complicated anyway. But what we're going to do is we're going to deal with this partitioning, because this 24,000, we're not just going to do something like this. We are not going to just say, oh, okay, well, I'll put 8,000 in each one of these and we'll just evenly split that. That's not right, right? That's not what we're doing here. There's actually an allocation method they told us, and it's based on sales. So on the next page, what we're going to do is use our tables to help us with this. Notice the books department generates sales of $495, magazines generate sales of $198, and newspapers $207. This gives us $900,000. That percentage of the total, so $495 divided by 900 comes out to be 55%. 198 divided by 900 is 23%, or sorry, 22%. And then 207 divided by 900 is 23%. This is, of course, an allocation of 100%, which is what we want. And now, remember, we're trying to allocate $24,000 in advertising. So 55% of 24,000 is 13,200. 22% of 24,000 is 5,280. And 23% of 24,000 is 5,520, giving me a total allocation here of 24,000. And what I'm going to recommend is go ahead and make these red. That'll make it easier for us to remember, oh, that's where that came from. And when I look back and I see that I've got all this stuff in red, it'll make sense. And we'll hold off on that for now. We'll go ahead and knock out purchasing also. Then we'll go back up and transfer everything all at once, just to save us a back and forth. Now, for the next part, we're looking at the allocation of purchasing. This is done on the basis of purchase orders. Books has 516 purchase orders. Magazines has 360 and newspapers have 324. All of this information that we've used from this right here is in this table. So if you're not sure where that's coming from, that's where it's coming from. And so what we're going to do now is figure out that total. They actually gave it to me as 1,200. 516 over 1,200 is 43%. 360 over 1,200 is 30%. And then, of course, 324 over 1,200 is 27%, giving us a 100% allocation, which is, of course, what we need. Now, what you'll do, you'll take that 43%. Remember, this is to allocate the cost of purchasing. Purchasing had a cost of 34. 43% of 34 is 14,620, followed by 30% of 34 is 10,200, and 27% of 34 is 9,180. Of course, allocating out the total, 34,000. I always recommend you go ahead and double check that your totals tie back to what you were trying to allocate. If you accidentally had a typo on any of these, when you add them up, you will not come out to this, and that will give you a different number, and you'll know, oh, okay, I need to go back and double check my calculator work. I might have made a mistake. So I'm going to go ahead, I'm going to make these blue, just so it stands out a little bit more when we get to the other page. Now, at this point, go ahead, if you want, take a picture of this so you can see exactly where it's going on the previous page as we go back. And so here we go. I'm going to zoom in on the previous page. Now, all we need to do is enter that information. So here we go. Under my books department, on that advertising department line, I'm going to enter 13,200. For my magazines, I'm going to enter 5,280. For my newspapers, 5,520. These are the numbers we computed for each department on the other page. Now we'll come down. For my purchasing department, I'm zeroing out purchasing, and I'm taking that 34 and putting it across the other three departments. 14,620 right here, 10,200 here, and 9,180 there. Now what we need to do is figure out our total expenses allocated to each department. Book department coming down, 425 plus 13,200 plus 14,620 is 452,820. Same thing for magazines, 105,480. Same thing for newspapers, 139,700. This gives me my total expenses allocated. And what I strongly recommend you do is take a calculator on the test. If you get a question like this, and what you will find is that when you add these three up, you will come out to 698. Because all you did, you had 698 here, you subtracted 24 and you added 24. You subtracted 34 and you added 34. So of course it comes back to the same overall total. Of course it does, has to. Okay, with that problem done, we are done with our expense allocation, and we're now ready to move on to our departmental contribution report. So here we go. Oops, forgot I went back a page. All right, on our departmental contribution report, what we're going to try to do is determine if we should eliminate a department. So I'm going to give you a second. I'm going to read through this, and then I'm going to give you a second to determine what your gut tells you we should do. Then we'll see if your gut is right. So below are the departmental income statements for a guitar manufacturer. The manufacturer is considering eliminating its electric guitar department since it has a net loss. And what they're looking at, of course, to determine that is right here, their net loss line. And you'll notice they are operating at a loss. Now, to be fair, that's an extremely small loss, especially relative to over $100,000 in sales. But if we have a company that says, hey, we eliminate departments when they have a loss, then it's on the chopping block, perhaps. So we've got to look at, see, would it make sense to eliminate that department? If yes, why? If not, why not? So the manufacturer is considering eliminating electric guitars. The company classifies advertising, rent, and utilities as indirect. So what I'm going to recommend you do, strongly recommend you do, is make a note. I hate when I use this pen that it does that. Okay, what I'm going to do, I'm going to go ahead and go back to my highlighter. I wish I could use the pen, but I know it's going to mess up the screen if I do. I'm afraid it won't fix itself quickly. So what we're going to do is we're just going to highlight those three. I know you may not be able to do this. So if you can't, then that's fine. But then make a note on paper. Remember, in this case, we were told advertising, rent, and utilities are indirect. That is incredibly important whenever we're dealing with a departmental contribution report, because what we say is if something is an indirect cost, if I eliminate a department, those costs they're incurring just get shoved off onto someone else anyway. So it may not actually be better off for us to get rid of that because those costs are going to just be absorbed somewhere else. So we do have to keep that in mind. So you do want to know that. That's the importance here. Now, what we notice, we're going to go ahead and start to prepare my departmental contribution statement. What this is going to look like is an absorption costing income statement. Very similar. Sales minus variable costs. Is that right? Would that be right for an absorption costing income statement? Sales minus variable costs equals contribution margin. Is that right? I don't know if that's right. By now, hopefully you figured out I'm going to make intentional mistakes to hopefully re-engage you and pull you back in if you're zoning out or something, so you see what the mistake is. And so what we have here is these variable costs and this contribution margin is not our correct breakout. What we want is cost of goods sold. So sales minus cost of goods sold, that will give us gross profit. Then we're actually going to split our expenses into two categories: direct expenses and eventually indirect expenses. So the three highlighted in yellow are indirect. Everything else is direct. So what we're going to do, we're going to go ahead, pull in depreciation expense on equipment, pull in salaries expense, and supplies expense. Now I've indented all of these by 5 spaces just to make clear these are all direct expenses and they're under that category, just so it's visually easier for me to follow. You don't have to do that if you don't want to. But if all of this is on the left-hand margin, it makes it kind of hard to tell what's going on. So I recommend that you do that, but you don't have to indent that. This will give you total direct expenses. Now, this line has a very important name that we've not seen until chapter 22. This is departmental contribution to overhead. When I'm looking at a departmental contribution report, when I'm doing that, this is the line that matters. This is the important line. If this is positive, keep the department. If this is negative, eliminate the department. Okay, that's where our evaluation takes place, at this line, not anywhere else. Now, our next section is going to be our indirect expenses. Our indirect expenses. Okay. And in this case, we've got rent expense, utilities expense, and I believe we had advertising expense also. That gives us total indirect expenses. And then this, of course, gives us operating income. And you'll notice that down there in that indirect section, a lot of those squares or a lot of those rectangles are grayed out. That's because you're not going to be entering anything in these. Indirect stuff, we just look at in total. We just look at in total or on a combined basis. So keep that in mind. Here we go. Or for the acoustic department. And what I strongly recommend is go ahead, take a picture of this. Or if you have a second monitor, maybe pause the video on the other one at this point, just so you can see the data. And then we're just going to zoom on down and actually just start pulling all of this in. So what we find is that my sales number here is 112,500. And for my electric guitar department, this is 105,500, giving us a combined 218,000. For cost of goods sold, we're told this is 55,675 and 66,750 for a total of 122,425, which gives us gross profit. Let's get our underline fixed. This is gross profit for acoustics of 56,825, for electric of 38,750, and for a combined total here of 95,575. Now, my depreciation expense on equipment was 10,150 and 9,000, giving us a total here of 19,150. For salaries expense, this is 17,300, 13,500, giving us a total of 30,800. For supplies, this was 2,030 and 1,700, giving us a total here of 3,730, giving us total direct expenses for the acoustic department, 29,480. For the electric department, 24,200, and in total 53,680. This allows us to compute our most important figure in all of this, which is departmental contribution to overhead. So in this case, for the acoustic department, 27,345. For the electric department, 14,550, the electric guitar department, right? And then of course, combined, we're at 41,895. So at this point, you can actually make the determination of whether or not we should eliminate this department. And what would your decision be at this point? Should I eliminate the electric department even though it's operating at a loss right now? And hopefully you said no, because here's the thing. Right now, we are contributing $14,550 towards those indirect expenses. Well, if we eliminated the electric guitar department, those indirect expenses that are currently being covered by this much would then all fall on this department. And we would no longer have any help covering those indirect costs, and would start to eat away at the actual income in total of the company. So we don't want to do that. So we will say at this point, no, do not eliminate the department. That would be a really, really terrible decision. But unfortunately, it is the simplest decision, which means that sometimes people will make that decision and it will not be well informed. So you don't want to be that person. So be careful. Because a lot of times people do, they react on their gut and they say, well, if I've gotten it lost and get rid of that department, it's hurting my company, it's hurting my company. Not really, right? While it's not great that it has a loss, I would be so much worse off if I got rid of this. So we can't do that, or we shouldn't do that. And then of course we've got the $12,055 in rent, the $55.95 in utilities, $14,325 in advertising, giving us total indirect expenses of $31,975 and operating income of $9,920. $9,920. And I want you to notice a couple of things here. Notice that what we just got, this 9920, that's just, okay, it's literally just the sum of this right here. Let me get a different color. It's just the sum of that. 10,120 minus 200 is 9,920. And further, there's actually another thing that we could have done, which is to realize that if I actually come in, I'll just show this on the calculator, and I add up the cost of all those indirect expenses, $62.50, $59.50, and $25.50, that's $14,750. If I take out of that the $200 that I'm losing, I can jump straight to this point without even doing any of this work, because it's giving me a shortcut to verify that this is right. Now on the test, you're probably going to have to input each individual number, but if you want to check yourself, this is a pretty good way to be able to check yourself. So if you had income here, of course, you would have needed to add, but in this case, you can back it out because you actually had a loss. And so this does work out, and you could see that, oh, okay, I will get a positive number there. And it's because you would be giving up, right, even with incurring all $14,000 of those indirect expenses that are allocated to this department, we only lost $200. Well, if this department is gone and can no longer absorb that $14,000, those indirect costs will have to be absorbed by the acoustic division, which now will actually pull this down, and my company will actually be operating at a loss in total. So it'd be a really, 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 really bad managerial decision to decide to actually eliminate this department. So don't do that. Don't be that manager that rules off your gut. Rule off the facts, right? And the facts in this case are you're much better off by keeping this department, even though it's operating at a loss, than if you were to eliminate it right away. So do keep that in mind, and hopefully that makes sense. All right, with that done, we got just a couple of questions left to wrap up. The ones that we've got left are all fairly quick, so we should get through these much, much, much faster than the others. First two questions that we're going to look at on this page are all just different ratios and different types of analyses. So we'll walk through them fairly quickly. I do believe these are on your test, so you do want to be careful. I mean, a lot of the stuff in the review is, of course, on your test. But this is not something I spend a ton of time on in class, but I do want you to be aware of these things and know that, hey, they do matter. People do actually look at them, and they are actually helpful. So we're going to go ahead and knock those out and go through them real quick and see what we can come up with. So we're asked to compute three different things: return on investment, profit margin, and investment turnover for our two companies, or for our two divisions within our company. We've got the beverage division and the cheese division. And so when we're calculating return on investment, what we've got to remember is that formula is operating income divided by average assets. And that will give you your return on investment. So for the beverage division, this is $349 over $2,628. And then that will give us 13.28%. And you say, well, that's great, but when I'm looking, I don't see 2628 anywhere in there for the beverage division. So where did that number come from? Well, look at the title, average assets. So what we had to do here was we came in and we said, well, at the beginning of the year, 2662. At the end of the year, 2593. Divide that by 2, 2628. That's what we got. I mean, it's of course rounded a little bit, but that's where this comes from. And that gives us 13.28%. For the cheese division, we get $634 in income. We have much more in assets though, 4,428 comes out to a 14.32% ROI. Now, if I'm comparing the two divisions, cheese is slightly better than beverage, because what this is telling me is how efficiently I'm using my assets to generate income. The more efficient I am, the higher that number and the better off the division is. So we do like, in this case, the cheese division a little bit more than the beverage division, looking a little bit better with this analysis. Profit margin is our next item. We're going to look at operating income divided by sales. Will give us profit margin. Now, operating income, 349, 634 again. Sales, 2,681, 3,925. And if you want to keep your dollar signs in at least the first row, you can. This gives us a profit margin of 13.02% and 16.15%. So what this is telling me is for each dollar of sales, 13 cents is going to profit for the beverage division and 16 cents is going to profit for the cheese division. That's a good thing for cheese, at least relative to beverage. Cheese is doing better. And so we would say out of these two, cheese is outperforming beverage again. Now with investment turnover, our formula, sales divided by average assets. We've already seen how to compute our average assets. So we'll just pull that straight down. And we've already got our sales right here. So we can pull that straight down. And this will give us our investment turnover. This gives us 1.02 compared to 0.89. So what this means is that my beverage division is doing a better job of using their assets to generate sales. Okay, so in this metric, beverage is beating cheese. So what I want you to see here is just because you win on one of these does not always mean you'll win on all three of them. You might win on one, you might win on two, you might win on all three, or you might only win on one, right? And so you need to be clear that there are some different possibilities. You can't always just assume, oh, okay, well, this department beats the other one in this area, so it must be better at everything. That's not true. That's just not true. It's an overly simplistic view of analysis, and we don't want to leave with that understanding. So very good. Now, for our next one, what we want to look at here is our residual income. So refer to the information. So it's this information right here that we just used for the last problem. Assume that each of the divisions had a required rate of return of 7%. Compute residual income for each division. So what we're going to do, we're going to start with our operating income. For the beverage division, that's 349. For the cheese division, that's 634. We're then going to compare that to our target net income. And our target net income, it told us, is 7%. So we have a required rate of return of 7%. And that 7% is of our invested assets. So we're going to take 2,628 for the beverage times 7%. And here we're going to take 4,428 times 7%. When we do that right here, we'll get 184. And for cheese, we'll get 310. What we end up with is $165 for beverage and $324 for cheese. This is my residual income division. And so what you want to notice about residual income is that residual income is really interesting, because if I were told that I have a target profit of 7% and I was approached with an investment opportunity that returned 9%, should I accept that opportunity? And the answer is yes, of course, right? My target is 7%. I can make 9, that's good. But if I were cheese or beverage and you were only evaluating me on ROI and I accept a project that's bringing in less than 13.28% or 14.32%, I might be inclined to reject that because it's going to lower my ROI. Well, that would actually be a bad decision for the company, and the overall health of the organization. So we don't want to only evaluate on ROI. Something like residual income is really helpful because it tells managers, hey, if you have a project that is above the required rate of return, accept that project because it will increase your operating income without increasing your required or without increasing your target income. And so this will get larger and that will be better. We want a larger amount of residual income. So very good. So that handles all of that stuff. And now we're ready to go ahead and move into our last two problems. The good news is our last two problems have no math at all. There are a few numbers just mentioned, but we don't have to do anything with them. It's really just an analysis. And we've got the same problem in two different situations. This is actually covered in one of the appendices to the chapter, but it is one of the appendices that I love covering in 2302. So it is absolutely on your exam. So if you want to go through the appendix, I believe it's Appendix B in chapter 22, at least in the current version of the book, that's where it is, but it's the section on transfer pricing. So if it's in a different section or something, make sure you read that. But here we go. Basically, what we're looking at is we've got a company with multiple divisions, and we're deciding at what price do I move my inventory from Division 1 to Division 2? Because what we're really doing is selling stuff interdepartmentally within the company. And so if I'm the one who produced the product and I'm selling it at a really low price, it's going to make my department look bad. And if you're the one buying this for your department and you buy it at a really high price, it's going to make the cost go up for you and make your department look bad. So it puts both managers against each other, kind of, where really they're working for the betterment of their department and they want the best deal for them. So you put both people looking at two different goals. You're trying to figure out what price is fair all the way around. So the first situation is when we do not have excess capacity. The windshield division of Fast Car Company makes windshields for use in Fast Car's assembly division. The windshield division incurs variable costs of $200 per windshield and has capacity to make 500,000 windshields per year. The market price is $450 per windshield. The windshield division incurs total fixed costs of $3 million per year. If the windshield division is operating at full capacity, what transfer price should be used on transfers between the windshield and assembly divisions? So this is where we ask, well, what price would be considered fair? Well, if the windshield division already has customers or the ability to sell everything they're producing at market price, will the windshield department accept a price below that? No, it will make their department look worse. So they're sticking at $450. Now let's see if that logic works from the other side. If that's the market price for that windshield, why is it the market price? Because that's the price a similar type windshield from someone else would also cost. So could my assembly division buy that same grade of windshield from anyone else for less than $450? No. So if they're going to have to pay $450 to someone else, they're not going to mind paying $450 to me. So this sets the price at one individual dollar amount. It is the only amount that is acceptable in this case, and it is $450. So we say, without excess capacity, a market-based transfer price of $450 per windshield is the only price that is acceptable. The only price. Now, what's going to stop my windshield division from charging assembly $500? So you say, well, couldn't we charge them more than $450? Well, no, because what's my windshield manager doing? Well, they're going to look around and they're going to go, your windshield isn't any better than this other company's. And they're only charging $450. Why am I going to pay you $500? I'm not. I'm going to go buy it from them for $450. So that's how we land at this one individual price. From both sides, that's the only value that makes sense. Now, situation gets a little bit more complex when we do have excess capacity. When we do have excess capacity. So in this case, we are told we have the same information, but we are told if the windshield division has excess capacity, notice even the changing in the way the question is worded. What is the range of possible transfer prices versus here, what transfer price should be used? Meaning one transfer price, meaning more than one transfer price in this case, right? So that's what we're looking at. In the first problem we did on this page, only one price was acceptable. right? If you gave me a range for the first one, it's wrong. The range is wrong. Can't be a range, it's one price. But here, we do actually get a range. And the question is, how much, or what's the bare minimum price I would be willing to accept if I were the person who were actually making the windshields? If I were the one actually making them, if I'm the windshield division, what is the absolute lowest price I would even consider selling this at? Well, the absolute lowest price I would be able to consider selling this at is $200, because that's my variable cost. It's going to cost me $200 to build this for you as the assembly division. That's the cost to me. The fixed stuff, I'm incurring that whether I make this to give to my other department internally or not. So I'm not as worried about covering that. My other sales can hopefully do that for me. But I'm going to incur additional cost of $200 per windshield to build these for the assembly department. So I'm not going to sell you this at a price less than $200. But can I sell this to you at a price above $450? Well, once again, the market price is $450. If I try to sell above that, you're not going to be willing to pay it. So you're not going to do that. Now, truthfully, is the price going to be either one of those extremes in this situation? Is it going to be exactly 200 or exactly 450? No, probably not. It's probably somewhere in there. It might be 250. It might be right in the middle at 325. It might be 375. It might be $382.18. We don't know. It's going to be something in that range, certainly, but the exact dollar amount is uncertain. So what we're going to say here is, if the windshield division has excess capacity, then a range of acceptable prices becomes available. This range will be from $200, which is the minimum because this is the variable cost to produce a windshield for the windshield division, to $450, which is the market price of the windshield. Once again, because that's the market price, assembly won't pay more than that. And odds are they're not going to pay that either. I mean, they know, hey, you're not able to sell everything, so we're going to help you out by buying from you. That'll give you something. And we'll get a lower price than from the market by buying internally. This will be good for everybody. And so we'll settle on a price somewhere in the middle. I'll say likely the final price will be negotiated at a point that is not either extreme value. So it's not going to be the 200. It's not going to be the 450. Most likely, it could be, but it likely won't be. It'll likely be somewhere in the middle. It doesn't have to be exact in the middle though. Make sure you understand it does not have to be exactly in the middle. It doesn't have to be 325. It could be, but it doesn't have to be, right? It could lean one direction or the other, but it should be somewhere in that range. Okay, and with that, we have officially wrapped up our exam 3 review video. So I hope you found this helpful. If you do have questions, as always, please do not hesitate to come find me either during my office hours, send me an email. Let me know if you need help. I'm here to help you. I want you to all be successful. And I think you can do it. I think you can do this exam. But I will tell you, similar to the second exam, if you are not prepared, you cannot finish this exam on time. If you are prepared, I don't think you'll have a problem with it. I think you'll be ready. I think you'll roll through it just like you did on the second exam, hopefully. But if you do not take this exam seriously and start studying early and work through this review, hopefully, I think you're going to really struggle on the test. This is a ton of information. Luckily, a lot of these concepts all tie together fairly neatly. So I think it's the most cohesive exam I give out of Principles 1 or Principles 2, truthfully, because so many of the concepts are so intertwined. But that intertwining of all the concepts can also be what makes this kind of challenging at certain points. So good luck studying. If you have any questions, once again, please reach out to me. Otherwise, good luck, and we'll see you in class. And thank you again.